Welcome back to FTFM. The latest revelations about Barclays and probably other banks rigging Libor have stunned institutional investors, adding to other worries about the Eurozone debt crisis. We asked Marino Valensise, Chief Investment Officer at Baring Asset Management and a specialist in asset allocation, what institutional investors are doing about the scandal and where they should put their money in such an environment. Marino, thanks for joining us.
Thank you.
What are institutional investors doing in response to Barclays? Are they heading out of the door in a panic, in disgust? What is the general response to the revelations in the past week?
Well, first of all, a reaction of astonishment because of what has happened and about the lack of oversight and governance on behalf of Barclays. In terms of investments, I believe that fund managers are already underweight banks since the subprime scandals in 2007, 2008. So I don't think that what has happened in the last few days is going to have an impact on investors' portfolios.
Did you, as institutional investors, know about what was happening?
Well, we obviously didn't. You know, we are surprised, although there have been since many years ago rumors about something happening in the Libor market. We have to remember that the Libor fixing mechanism is the only piece of self-regulation which has remained in the financial sector. Everything else is now, well regulated by the authorities and by the regulator. But Libor submissions are still done by the banks for the market.
You're an asset allocation specialist. Where would you advise investors to put their money currently? Would it be in developed markets, developing markets? Would it be in equities, bonds, or would it be in a mix of all that?
First of all, quality, and quality means United States. On the equity side, I think the opportunity is there. US corporates have done very well in the last couple of years. They have started rehiring, and we can see this through the employment numbers, but also US high yield for this very same reasons. On the other side, emerging market stocks and bonds, GDP per capita will keep on going up. Currencies are undervalued, and probably both emerging equities and emerging bonds have got a slightly different and enhanced role in portfolios of asset allocators.
So a mix of emerging market equities and bonds and US, which is presumably seen as a relatively safe haven currently.
Absolutely. And again, if we want to have a look at Europe and the UK, there are probably some opportunities in terms of multinationals. These are companies, typically large caps, or exporters, which are listed in Western exchanges, but do most of their business in the East and in emerging markets.
What sort of returns would investors be looking for, let's say, in emerging market debt currently?
In emerging market debt over the next 5 years, I would say that investors could expect a 6–7% from the income. So this is the coupons delivered by the bonds, plus probably 3–4% per annum in terms of currency appreciation. So all in all, I don't think that 8, 9, 10% per annum return from emerging market local bonds is something which is going to be impossible.
But would that currency appreciation be over a more long-term or mid or long-term 4 or 5 years, or could you expect that as an investor today?
There will be a lot of volatility in the currency market because we have experienced that the dollar tends to go up and emerging currencies tend to go down every time there is a financial crisis. So investors must be patient, but over a time horizon of 5 years, emerging markets and their strength should really bring a lot of benefits to investors.
Thank you, Marino Valensise.
Thank you very much.